Find a part-time, or a CFO for hire, controller for hire. You can pay them $200 an hour, and they will do more to help your cash flow and understand your balance sheet. And that's probably one of the greatest things I've seen, people do.
Hey, welcome back to Building a Family Business here on Builder Funnel Radio. This is episode 19, and surprise, we have the same hosts with me. So, Wes and Brooks, how are you guys doing today?
Doing great. Thanks, Spence.
Good. Wes, I know we were chatting a little bit before we hit record, but what are you digging into these days?
Yeah, good question, or anyway, a question. I don't know if it's a good question, but
yeah, it's kind of a standard question.
I'm reading this book called The Men Who United the States by Simon Winchester. He's a British historian and author, and he just is talking about the way our transportation system developed in the United States and how we connected all the states together. So anyway, the thing I'm reading about right now is pretty interesting. I had really never thought about it, but at one point around the turn of about the 1800s or so, early 1800s, the preferred mode of connecting people up was water, which is, hey, we can just connect this river to that river with a canal, then we can get our goods from here to there. And so it's a very interesting section about the Erie Canal, which is 363 miles long, which they just trenched out. So, and it connects the Hudson River and the Mohawk Valley, and it runs right on over to Lake Erie. But it took them, I'm sure a couple of decades at least, maybe more. And it really did connect the United States up quite a bit, because it connected the East Coast with what now we consider, the Chicago area, all that type of stuff. So, and the whole goal was, hey, if we can connect these states together, and make it so Americans are trading with Americans, and the folks that had actually gone out exploring out what we considered West, which is now the Midwest, they wouldn't be trading with, say, the Spaniards or the Canadians or the English, and set up these other economic ties. And so by doing that, we kind of kept those states tied together. But really fascinating, the amount of work, and it's all hand work.
Oh yeah, you imagine
shovels and just
by hand.
And lose 1,000 guys, to death, digging this thing, and of course they move their barges. They have these paths next to the canal, and they just pull the barges along with donkeys and burros, and so really fascinating, and also the technology behind the lock system. There's multiple locks in these canals to raise the water level from one level to another. So if you're going up or down, you have to somehow figure that out. So anyway, it's very cool, very old technology, and obviously mostly replaced today by our interstate system and by planes as well. We can move a lot of tonnage on planes today even, but still go down the Mississippi River, a lot of barges.
And it's you can actually do some pretty cool trips, recreationally down the Erie Canal and see, that whole part of the country, on canal boats or whatever. So it'd be an interesting thing to do that and go, oh, this is, go back to the, early 1800s.
You can still go through all those locks. They're all
still there.
Operational.
Yeah.
They've removed a lot of the locks just as technology has improved, and they've done some workarounds, but there's still a lot of those locks, and they're all operational and working.
Even on the Mississippi, you lock through, on different parts as they, develop flood control and things like that.
It's interesting around the Mississippi, Brooks, since you mentioned that, but the Mississippi, actually, that basin touches 2/3 of the states.
Does it really?
Yeah. So it's massive. It basically divides the country from west and east, and all the rivers that flow into it. And so that whole flood basin is just massive. And it goes all the way from Canada to the Gulf of Mexico.
Well, and you think that, that's where Lewis and Clark jumped off, was from St. Louis, Missouri.
That's right.
To go out and do their big trek out to the coast.
Yeah. What's that little town right there outside of St. Louis they jumped off from? St. Charles.
St. Charles, yeah.
St. Charles, right? And if you've ever been to St. Charles today, they have, you know, some different little monuments there. And they also have a great car place there. So if you're looking for a hot rod or a muscle car, Gateway is in St. Charles, and it's got a cool showroom.
Been there a few times. Yeah.
I have been there a few times.
Left some of his money there.
Yeah, for sure.
Yeah. It's amazing too to just think about just how far we've come from that, but then how fast things move today, you know. And I joked before we hit record, but talking about just the like stuff like the Hyperloop, or, you know, and even you know, teleportation. Is that going to be, you know, something that ever they figure out, you know, if that gets down to the molecular level or something like that? But it's that's very futuristic, I think. Yeah. What's that? You never know.
You never know. I
know a lot of the stuff that gets written in books and you see in movies, then eventually it happens. Yeah. Yeah. Well, maybe we won't go down the futurist path too far today.
Probably not.
But last week we were kind of getting into a pretty interesting topic, kind of around this concept of having a fortress balance sheet, and we were talking about kind of different grades of liquidity and how to really set yourself up so that you're stable, you're prepared for the future, you're prepared for some unknowns, even if they aren't ideal situations, but these things can kind of allow you to navigate the waters with some more flexibility. So maybe let's just kind of kick off. I don't even know where this, you guys mentioned this term fortress balance sheet. Where did that even come from?
Well, I know, Brooks, you probably know too, I'm sure. But I think, who knows who really coined it, but most people give credit to Jamie Dimon, who is the CEO of JP Morgan and Chase. So he came up with that phrase at some point back in the O's, you know, like 05 or 06 or 07, somewhere in there. But basically it's around the concept of, hey, you know, you can miss your earning targets, but you can only run out of cash once. So, you know, having that balance sheet that allows you to withstand those seismic shocks that maybe you're not expecting.
Yeah. And so how do you, you know, that's obviously a pretty large company. How do you guys think about that concept at a smaller level, you know, family business, or, you know, even I think small business is categorized as like under a, you know, 50 million or 150 million or whatever it is. So, you know, depending on which report you're looking at. Yeah. But I guess, how do you guys think about that fortress balance sheet? How do you build one? How do you develop one?
Well, you know, the thing that, you know, what is a balance sheet? I guess that's the first question. You know, a balance sheet is your assets versus your liabilities. And a lot of times when you run a small business, you might just run out of your checkbook. You might never think about your assets and your liabilities. And so that's a good first step, is to sit down on a piece of paper and say, well, what are all the things that I own, and what are all the things that I owe money on, my liabilities, and see if that's a positive or a negative number. In real estate, you know, that number can change because your assets could be worth quite a bit one part of the cycle, and your liabilities don't change into another cycle, and your assets can go down, and the difference can, you know, fluctuate. But the critical thing about, you know, a balance sheet is it's a point in time, but you always have to have cash flow.
Yeah.
Regardless.
Yeah, I think that's a good way to look at it. I mean, Brooks, as you were saying, you know, as you're listing all your assets, say on the left side of the sheet, and then on the other side, on the right side of the sheet, you're listing all your liabilities. And as Brooks pointed out, you know, if you take the total of what you think your assets are worth and you subtract what the liabilities are listed on the right side, then right below your liabilities, you're going to say, well, the difference really is my equity. And that's, you know, one of my worth, which is the difference between what I have and what I owe. That's what I'm worth. And so that's why it's a balance sheet, right? Because you can take your liabilities and what you're worth, and that should equal what your total assets are. So to Brooks's point about cash, though, I mean, as you think about your balance sheet, you go, well, I've got short-term assets and I got long-term assets. If you're thinking about this for the first time, so your short-term assets are really anything that's 5 years or less. So, as Brooks is saying, it's going to be your cash. It's going to be maybe you have some stocks and bonds. It could be your equipment, like your trucks, tools, anything like that would be kind of in that short-term category. And then the long-term category is maybe you own some raw land, or maybe you've got some rental houses, or anything like that would be your long-term liabilities. I mean, your long-term assets. And of course, you can't really eat raw land. You can't eat dirt. So when things get a little bit tough, you got to have enough cash on board to do that.
So as you're thinking about, the assets, let's just take an example, say you got a building company, they're doing a couple million in sales, or remodeling company. How do you start to develop those assets? Let's say you've been running for 5 years, you kind of built up, a good revenue stream, but now you're really looking to fortify yourself in terms of those assets. I guess, do you guys recommend certain types of assets? What do all those assets look like? You kind of listed some short and long term, but do you have some recommendations about how you can start to take steps towards really building your own fortress balance sheet?
Well, I borrow a lot of money first. Borrow as much money as you can while the times are good. It was interesting. As we're preparing for this, I was doing some research, and one of the things that the recommendations was, on your balance sheet, you should have things that produce other income. And I really never thought of it that way. It's just like, you got your construction business, it's running, that's your big cash machine. And in our experience, we actually did do that, in that because we're in real estate in the construction business. So it was very simple for us to then build rental properties or acquire rental properties. And so that became another revenue stream off those rental properties. And it was never, in the first 20 years, it was never equivalent to what the construction business was doing, but it was another source of cash flow. And if you buy into real estate and into the concept of real estate, then you have the appreciation of real estate over time. So, but very, very illiquid. So, like as Wes said, you can't eat dirt. So, if things get bad, you can't sell your real estate probably when you want to, or it takes a little while. So it would just be one component, but it could provide income from another asset, and it's part of your balance sheet.
I think a good way to look at it is, what if I couldn't do any business for a year? What would I want to have on my balance sheet? Because as Brooks was talking about, values go up and down. So and I'll give you an example. So in the downturn in 08 or 09, in that time, I was in the mail processing business. And so we had a lot of equipment. And so this equipment could produce revenue, right? Because you would process mail. And so that's an asset, and you depreciate it, but it's able to produce cash flow for you. But as the volume went down, didn't produce much cash. So it became less valuable to me. And eventually that business wasn't a viable business to produce mail, because really everyone shifted over to email and other types of marketing for the most part. So what you found is that, okay, you have a downturn, and you also have a shift in how people are doing business and communicating, all those types of things. So on your balance sheet, you go, okay, well, I've got, $1 million worth of equipment here. So that's an asset, right? So if times get bad, I can just take that $1 million worth of equipment and I can just sell it. And so what we found was that when times got bad, sure, I could sell my equipment, but so could every single other person that was in the same business that was all, trying to exit at the same time. And so that $1 million that you have on the balance sheet, or what you think your market value is, can plummet to almost zero. And
or
so
a
the same,
negative number.
or a negative number, right?
You're paying someone to come take this away.
Yeah.
Exactly right. And in some cases, that actually did happen. But well, this string tire that wraps around, a bundle of mail, you have to have the junk man come and take it. So I think as you're looking at your assets, because we tend to overvalue our assets.
Absolutely.
I'll give you another example. Would just be the idea, we list our trucks on our balance sheet. And so that'd be a short-term asset. I've got vehicles, and so you got these trucks. And those trucks are essential for doing your work lots of times. But those trucks cost money to keep on the road. And so even though they're listed as an asset, to keep those trucks around, you're going to have to, put gas and oil in them, but you're going to have to keep the registration up. You're going to have to make repairs. And so if those trucks aren't earning for you, then they actually flip very quickly into more of a liability, right, in a real sense, because they're actually costing you cash to keep those things around. And so I'd say, look at your list of things and say, what's costing me cash? So, Brooks brought up the idea of, well, you can have things that generate cash, like rental houses, but depending on what the rental market is and what your loan is on the rental house, then that actually may eat cash.
Right.
So you're always looking at that balance and going, okay, what if things really go south? Is this going to flip from being a cash generator to a cash eater, or is it just going to be cash neutral?
I think you want to try to cash neutral. Sorry, Spence. Go ahead.
Oh, it's okay. I was just going to say it's funny because as you were talking about the truck example,
Mm-hmm.
It's classic rich dad, poor dad, and thinking about, he kind of defines assets as things that produce cash for you. But in the traditional balance sheet sense, you look at stuff like, trucks or things like that. And like, technically it produces income as long as you've got jobs and people are in the trucks and they're utilizing the trucks, but they're not really a cash producer.
And you have to, and also technically, I used to always use the definition with my kids. It's like, it says it's an asset, but it's a depreciating asset, which means it's going down in value every day that you own it. So, great. You buy this nice new truck and, for $70,000, and it's just going down in value all the way, to zero. And we had, at one point, speaking of trucks, we had, in the renovation business, we had 15 vans going, and each van could make you a lot of money with a guy in it, but it also cost, just to keep that van on the road, $1,500 a month, in fuel and insurance, and then if it wasn't on the road, let's say things got slow and you parked a few vans, each van still cost $400 a month for insurance and all that stuff. So it goes to Wes's point, which is that, as long as everything's fully utilized, fully employed, then it's making you money. But if it's not, then it's costing you money. And we had that example of Wes you brought up, which is, our real estate portfolio going to 2008 was worth, $14 million. In 11, it was worth $5 million. And it went from having a positive cash flow to a negative cash flow because it wasn't over leveraged, or over loaned when we went into the downturn, but it very quickly became over loaned and rents went down. And so that's that question you have to ask yourself: would this stay revenue neutral? Would it go negative cash flow? And just run through those scenarios. Okay, well, how would we do that? What if that did happen? If your question of a fortress balance sheet becomes, well, if the fortress breaks, how do you retreat and keep enough things around so that you can live to fight another day?
Yeah. You're always looking for those weak spots in the fortress wall, which might look very small, but can really cause immense damage because the marauders can get in through that little breach in the wall and cause all sorts of problems. And so I think what that kind of makes me think of too, I guess, Brooks, we've talked about credit facilities and lines of credit and things like that, which are super valuable for us to do our business, right? Because they're a ready source of cash that you may not have. But what you want to do is, most lines of credit do have a term on them. So it's a 2-year term or a 5-year term or some sort of a term. But one of the things you want to do is you look at your Fortress balance sheet and go, okay, well, if I've got this line of credit, say I've got a $2 million line of credit, and I can go in and out of that line of credit. If times are good and it's a 5-year line and you're 3 years into that line, then that's the time to go ahead and extend that line again out for another full 5 years. Because what you don't want to have happen is what happened to a lot of people in various downturns is that they have a pretty good line and they're fine. They can weather this downturn, but in the middle of the downturn, their credit line comes up for renewal. And so maybe through no fault of their own, the bank doesn't want to renew it. So then all of a sudden that bank issue becomes your issue. So when times are good, always look forward and try to keep pushing out the end date. And then the other thing I think too is just look at the covenants on the lines of credit and see what can happen in terms of them pulling the line of credit. So once again, what you don't want is you don't want your line of credit pulled through no fault of your own, but just because the bank is nervous about general economic conditions, anything else that's going on.
Or they're nervous about the class of business you're in.
Yeah, right. Yeah, they just say, "Oh, I don't know if remodeling is a good line of business right now."
Yeah. That comes down from Jamie Dimon on high. Says, you know what? I don't like remodeling right now. And done. They're not doing remodeling anymore.
Right.
We had a Visa card with B of A with $100,000 limit that we used extensively in our business, and they decided, B of A is like, no, we're not doing credit cards for construction companies anymore. Gone.
Right.
But I had another $100,000 Visa card with a different bank, so that took care of that. Yeah. But it goes to that. It's the belt and suspenders approach. Goes to Wes's point, which is when we started out in the business, I remember I got my first line of credit for $25,000 against our house, and my wife's like, why are we doing that? I said, well, you never know what you're going to need. And we used that line of credit to build a couple houses back when $25,000 went further. And we continue to use that theory, which is every time I could get a line of credit on a rental or anywhere, I would get a line of credit, which is to Wes's point. And, we talked about the last podcast was all those lines of credit that we had, we drew down every last dime when we needed to. Probably part of having a good, strong Fortress balance sheet is having multiple banks that you work with. Because, one day, as Wes points out, one day the bank may decide, oh, we're not interested in remodeling or construction, but your other bank is like, yeah, we love it. And so you need to be able to move around. I mean, I'd say 3 banks would be the best way to have 3 relationships.
So Brooks, to dive into that just a little bit deeper, I know you talked about it last time a little, but as you're drawing down those lines of credit, but then you said you were moving that cash somewhere else, but do you have to move that, even say you're working with 3 banks and you have 3 lines of credit and you draw them all down? I mean, I'm assuming you got to put all that money somewhere outside of all 3 banks because they're going to want to try to, or how did you navigate that, making sure they weren't just like, oh, you drew it down and it's just sitting in your checking account. So,
well, you would never, we could spend a whole nother, podcast talking about banking relationships, I'm sure. But if you have a borrowing relationship with a bank, then they have the right to access your accounts. So they have that ability to do what they call rebalance your loans, which is we can reach into your checkbook at any point, pull that money out. So you just want to understand your loan agreements, and now it's much easier. You can have an online account with. I'm trying to think of who everybody does online.
Yeah, there's like an Amex online, or
Yeah. So you can have an account
IMG
somewhere.
or something.
Yep. You can have an account somewhere that's not related to any bank. Any of who you have lending relationships with, and so that would be your fortress. Your fortress should now be in this fourth bank where you could keep it. And you want to be aware of FDIC insurance and things like that. You don't, stack up a bunch of money in one place and it's only insured to 250. And so you have to think strategically about your lending relationships, because when we talked last week about leverage is super critical, and you need lenders to do that. And then you just need to manage those relationships.
But I think ultimately, and maybe this is just the whole, as you move along through life, you do need leverage, as we've talked about in other shows, in order to grow, fast enough. At least, so that's an opinion, right?
That's an opinion.
Someone else may have a totally different opinion and say, no, you don't need leverage at all. And that's fine too. But I would say that if you are leveraged, as you look at your balance sheet, you have to really ask yourself, leverage is always that weak point in the wall.
Yep.
Okay. Because that allows someone else to access your business. So anytime a lender can say, hey, yep, I can access your accounts. I can, you have to turn over all your financial data, all those types of things. That's all written in those line of credit agreements. So anytime that's the case, you've got somebody else that's kind of, in your business.
In your business, yeah.
Yeah, and that's because they're providing something for you that you need, which is cash and liquidity. So I guess my recommendation is, over time, as quickly as you can, you want to, let's say you do have rental houses. Well, if you can consolidate and remove loans, and maybe you have 10 rental houses and they're all leveraged, and you can go to 5 and unleverage, or 4 and unleverage, look at your cash flow and go, well, is that the same cash flow that I'm getting out of 10 leverage units? Yep. Is now a good time to consolidate those units? Because if I do that in a good market, if I can sell off 5 of my units and pay off the loans on the other 5, let's say, then all of a sudden I have what Brooks was talking about at the top of the show, which is a source of cash flow that can't really be messed with. It can be messed with in the sense maybe you can't rent the house, but that can happen with a leveraged unit. So as long as you got that cash flow, if you don't rent it anymore, at least you're not going to lose that asset, because you can't pay the mortgage on it. So that would be my goal over time, is to try to unleverage.
Yeah, delever.
Move through your business career, and the quicker you can get there and still meet your business objectives, the better off you'll be. And the same thing with your cash positions. Is that your cash or is that borrowed cash? Right.
It's a good point, and I think the challenge is, as you move through time, you get used to being levered or having leverage, and so you don't think to delever. And it would depend on especially we've talked about bringing kids into the business and growing the business, which takes probably continued leverage. And so maybe some of those discussions are with, oh, well, as we transition this business, the younger generation coming on is going to take the leverage and take the risk, and the older generation is going to roll out because they don't want to take the leverage and take the risk. But as you do get older, the more you can delever, as Wes says, and pay things off, just the more relaxed you'll be. I mean, we actually just did a study on our portfolio and said, well, how many units would we have to sell to be paid off with the bank and not have any leverage at all? And it was kind of an interesting study, but it was about, I think we had to sell a third of the portfolio. So then you're like, okay, well, great. Now I don't have any leverage. It's all paid off. It's all cash flow. Then we had to pay a bunch of capital gains. So you have to reconcile. You say, okay, I'm paying the capital gains, and then that 1/3 of the portfolio is not appreciating at if you think real estate appreciates at 3 or 4%. So you're making those, there's a lot of different layers of decision making. So you have to really decide what's your comfort level with risk or with leverage. But I like Wes's point, which is, hey, if you can get to where you don't owe anybody any money at all, it's a pretty nice place to be.
Well, once again, I think, Brooks, I mean, that's a good point that you guys went through that analysis, because if you're asking yourself that question, what would happen if I couldn't do my remodeling work or, build and sell houses for a year? So I didn't have that cash flow coming from that ongoing business. What's going to happen to my other assets? And if you're looking at your portfolio and going, well, my leverage is low enough. I've got loans on these units, but I could go vacant on X number of them and still meet all my obligations for my mortgage payments. And I'm okay with that, because I don't think, my occupancy will drop below 60% or 50% or whatever it happens to be. And once again, that's a little bit of a guessing game, and it's you looking at it and making that decision. But I think you can kind of go through those mental exercises, and I really encourage everyone to do it. I mean, I wish at different times in my business career I'd done more of those mental exercises, which is, okay, what if everything goes to zero for a while? Due to a bad recession or something that's happening in the economy. How solid am I in order to meet all my obligations? Because at the end of the day, you want to meet your obligations.
Yeah, absolutely. And I think as you're looking at your long term, as you take on debt, look at what and as it relates back to the fortress balance sheet, because you take on debt, it affects your balance sheet, but also all those covenants and things that you're agreeing to at the bank affect your balance sheet, because it does give the bank the right to reach into your business, as Wes said. It also gives them the right to, look at your business all the time. And, we kept running into, as business changed, oh, we have this debt on this asset. Oh, and we wanted to refi it because rates were lower, or we wanted to sell it. Oh, here's a prepayment penalty that we didn't really pay attention to. So prepayment penalties are the worst, when it comes to you're trying to change something. So we did this exercise on the portfolio about, we could sell off, a third and get to zero. It's like, oh yeah, well, we still have a prepayment penalty for X number of years on that portfolio. So a good idea when we get there, but probably not a good idea right now, financially, because of that. So again, there wasn't anything I could do about the prepayment penalty when I got that debt, and I needed the debt. So that's what I had to agree. We had to agree to, but it's just good to know.
Yeah. As you guys are talking, just kind of circling back around to the asset side of things, it seems like the game is kind of this combination of building up assets that are producing other streams of cash flow. So you've got kind of that safety net or backup in terms of if the core engine, the core business kind of stops producing or gets cut in half or something like that. But then you're also trying to build up these credit or lines of credit and different areas that you can access cash as well. So you're kind of working both of those angles. Are there, I don't know, are we heading in the right direction there? Or how should, if somebody's really trying to put those things in place, it seems like it's just kind of a battle between, lifestyle increase or building up your asset base. And,
I don't know, Spencer, if I look at it as lifestyle increase. I think
well, I guess I should just clarify that in the sense that a lot of people, like, say you grow your revenue from 2 to 3 million and your income goes up. Most people just spend that income.
Sure.
Well, that's a whole different.
Well, I don't agree with that at all.
Yeah, I don't agree with that at all either. Yeah.
Not at all. But I think if you think of your lines of credit or your credit facilities, I would look at them more as insurance policies.
Yep. Absolutely.
So if you think of it that way, instead of, hey, I got to have this line of credit because I'm in the line of credit all the time, and borrowing and paying it back and borrowing and paying it back, you can operate that way. But unless you know how you're going to pay that line of credit back, then don't draw it.
Yeah, that line of credit is an insurance policy. That's the way I'm glad you brought it up, Spencer. And it's an insurance policy. So we wouldn't be in our lines of credit at all unless we said, hey, we're gonna make a decision to acquire this piece of land. We're gonna be in our line of credit for 12 to 18 months, and when we refinance that land for development, that line of credit gets paid off. We did that all the time, and so
Sure, that's
so
a
that's where
strategy.
that's a strategy. Line of credit can help you achieve that. I mean, you could have a line of credit with friends and family that just said, hey, if I have an opportunity, anybody interested in loaning me 500 grand for this amount of time, you'll have people raise their hand all the time, or you'll have five people at 100 grand. So that's just a strategy. So it's insurance for when things get tight. If you're gonna, and really what those lines of credit do is they just buy you time. If you have a good strategy and you're like, I can see, light at the end of the tunnel, how we're going to get through this, but I am going to have to borrow to get there, and then I'll pay it back. That's fine.
Absolutely, and that's why you have it. Yeah, that's why you have it. It just makes your freeway a little bit wider that you can run in. So, but once again, just keep trying to build up that cash. And some people say, well, and I've got a lot tied up in the stock market, or they'll put their cash there. So another thing to think about is, okay, well, if I have to access that, if I have to sell it, Brooks was just talking about capital gains. If you have to sell your stock at a bad time and you've got a lot of capital gains there, then you're going to be writing a check to the government. So in that case, you might say, well, the stock has gone up quite a bit. Can I borrow against the stock? Kind of like borrowing against your 401k or something like that, because it's just a short-term need. And so you don't want to have to liquidate that stock investment. So once again, though, it's having that balance between the different types of short-term assets that you have the liquidity when you need it.
Yeah, it really seems like, you really got to run that worst case scenario, because you both mentioned those examples of, during the downturn, either the equipment that you had, Wes, or the rentals that you had. The time when you need the cash is usually when things are not going well. And so, but that's when assets are dropping in value, and, it's tougher to sell stuff. And, so it seems like that almost is that starting point is, what does this scenario look like if things aren't going well? Because if things are good, like you said, the goal is not to be tapping into the lines, or it is a strategic move and not a, oh my gosh, I need this cash type of a move.
A fun way to think about it is like, okay, if there's going to be a downturn, we don't know when it's going to be. What do I think the opportunities might be during the downturn?
Right.
And that might be a more fun way to then think, oh, I'm going to stack up an extra few $100 grand here in cash. So when we are in a downturn, I could buy something that was a distressed property. So there's going to be all sorts of opportunities, because people are going to be in tighter cash flow situations than you might be, and they'll need to bail out, and you're there to. We at different times we're able to buy land where other people had bought it. It's like, oh, they've got to sell it, and we had the cash to do it. After the last downturn, we were so debilitated that we weren't able to take advantage of all sorts of opportunities that people were able to scoop up land opportunities in 11, 12, and 13, and we were still struggling. And 5 years later in 17 and 18, they saw the fruits of those investments, and their earnings were exponentially greater than ours because of land value.
Yeah,
and they just had more cash.
Yeah, and all the best deals are in a downturn, right?
Right.
So there's always a winner and a loser in every top of a market and bottom of a market. And so that is another very positive reason to build cash and say, well, I'm building my cash, and I am waiting for the opportunities that will present themselves when other people are not able to take advantage of those opportunities because they're short on cash.
Yeah, and you might take a little bit of a contrarian approach, which is, hey, I'm going to just squirrel away this money while because we're making a lot of it, and we're going to save it up, and I'm just going to watch for the deals.
Mm-hmm.
And Warren Buffett's a great one for that. He watches for the deals. So that's something.
It does require you to have a longer term outlook in life, and I think the folks that do practice that practice looking out 5 years and 10 years. Obviously, we can't predict the future. We had a little conversation about futurists and what a great job that would be, because you can say whatever you want. And no one's ever going to call you on it. But, we can't predict the future. But if you do practice trying to predict the future and look out 5, 10 years, then you'll just get better at preparing yourself for different things that could happen.
Yeah, and it seems like, I guess a key element of the Fortress balance sheet then is decently heavy in cash, because that gives you that flexibility to either protect the downside, or, to your point, Brooks, probably the better way to look at it is those are where the best opportunities are, is when, things are depressed, and, but if you go into it cash heavy, then you're probably going to be in a really good spot to both protect yourself and take advantage of some opportunities.
If you think about it, you think about it, the companies go out of business because they run out of cash. That's
right.
So they're not making a profit, and so they burn their cash. And if you borrowed too much, then you either have to repay it during a downturn, or you can't repay it during a downturn. So the sooner you can get to all cash with no debt, just the better life is. And sure, your returns will not be as great. Your return on investment will not be as great. Your return on equity will not be as great. But you'll sleep a lot better.
But that's a good point about the cash and, running out of cash. And we've probably all heard of examples of companies that were growing so fast that they ran out of cash and they couldn't gain any more cash. They couldn't bring in more whatever it was, but they ran out of cash and they were out of business. So they actually just kind of burn out because they grow too quickly and they have to keep expanding. And, they just, growing companies eat cash.
Right. And in small companies, like in the construction business, the remodeling business, you don't have access to public money.
Right.
It's private money, it's friends and family, it's small community banks, and you just can't go to the public market and sell more shares.
Yeah. Good points. Well, as we kind of wrap up this conversation, Wes, what do you think are kind of some key highlights or takeaways as people are maybe starting to think about this in more detail and all these moving parts that we've kind of talked about? What are the first couple steps that somebody should be taking to kind of start getting these things in order?
Sure. Well, I think first and foremost, make sure that you do have a balance sheet written down, and a realistic balance sheet. Really assess. Don't make up values for things that don't exist, right? So really know what your assets are worth, know what your liabilities are. So I think that's step one. And I think step two, ask yourself, hey, if things go south for a year, what would happen to this balance sheet? Can this balance sheet withstand that? Would I be able to pay the service on my liabilities? What would I do? And so I would start there with those two things. And Brooks probably got a few ideas as well.
Yeah, I would add to those same things. A couple things is if you have access through your building association, or I know through the NHB, they for sure do, and remodelers, counselor, and some of those, find a part-time, a CFO for hire, controller for hire. You can pay them $200 an hour, and they will do more to help your cash flow and understand your balance sheet. And that's probably one of the greatest things I've seen, people do. If they think, that's really not my thing, having somebody like that really who understands cash flow, understands your business in construction, and can help you with your balance sheet and with borrowing. The other thing we didn't touch on balance sheets is, on your balance sheet as an asset is your accounts receivable. So if you're in the remodeling space, it's not so much in new construction where you get paid before you transfer the house, but in remodeling, be super diligent on your collections. You should collect 100% of your receivables within 30 days. No one, you're not a bank. So that's something to look at, and that can really improve your cash flow, which is, cash flow is your business oxygen.
And that's a great last point, Brooks, I think, because that is something that we often miss, because it's on the asset side and we're going, oh, look at, people owe me money. That's right. They owe you money. You do not have the money.
Better to collect.
Yeah, it's hard to pay your bills with the money they haven't paid you.
Yeah, and if you're not good at collecting money, then find someone in your business who is good at collecting money. So in our business, I'm the one who collected the money. Yeah. If I've done work, you better pay me.
Yeah, pay up.
Pay up
Yeah.
now. Yeah.
Yeah. Well, and we might need to spend some time digging into, cash flow and
Yeah,
that
no,
sort of
that's a
thing
good,
too. Cause, we covered a good chunk on the balance sheet today, but, they go hand in hand and they're both critical. So, thank you guys. This was good. And for everybody listening, hopefully you're out there working on your Fortress balance sheets now. And, we'd love to hear from you as you guys are working along through it. And thanks, as always, for tuning in and listening to Building a Family Business here on Builder Funnel Radio.